what's happened, on the documentation side, the underwriting side, with CMBS2 and with the current sort of government regulations? How's that going to impact your business?
I don't think it, well, in terms of CMBS retention, I'm not an expert in that, I follow it like everybody else, but I don't really see much changing. I think if the buyers of the B piece, if that counts as retention, I don't really see any change in terms of that issue with Dodd-Frank. I do think there is a lot of difficulty in operating in terms of how you communicate, whether it's with the rating agencies. So I do think there's a lot of kind of operational obstacles that are not allowing money to source investment opportunities. But I think it'll be a more cumbersome process, and I think that the regulatory pressures that I think are just the capital issues pertaining to banks, which I think are more of an issue, is just the risk weighting of assets and how expensive it is for banks to own leveraged loans, as well as looking at if we're at a $3.4 trillion market, half of that product is owned by banks, and half is European banks. So you're seeing capital really come out of the system, leverage capital, and so the whole is going forward. There was a study that was done, I think it may have been actually Deutsche Bank, Jonathan, showed that roughly 25 to 30% of the loans are inside of a 7.5 debt yield, which means there is going to be a lot of capital needed at higher leverage. And at the same time, you have banks that are facing risk weighting and making it more expensive to own leveraged assets. And I think that's really kind of the pressure. I don't think it's coming in terms of regulatory pressure from retention. I think that Wall Street and Wall Street lobbyists will figure out creative ways to beat that. I think the issue is really coming down to who's going to replace that leverage capital. And if it's not going to be held in the banks, how is that going to work its way through the markets?